You point out that we've seen things like this before, and we may have an idea how the stock market and bond market react to geopolitical events, and this could be similar. Are you still of that view that this is not different enough to where all bets are off this time around? Because it seems to be like it could turn into something a lot more concerning than some of the other historical precedents. But you think 10% correction, that's about right, and they're got to get used to them, and this is just another one of those?
Well, I mean, it obviously depends on, the outcome. So I think what we're watching is whether this geopolitical shock is different enough from prior geopolitical shocks to warrant, kind of significant fundamental changes to the market. And I think the transmission mechanisms would be via European growth, energy, oil price spikes and inflation and the impact on consumer and corporate confidence, the idea that we're at peak globalization. But, Joe, I think a lot of these themes were in play before the Russia-Ukraine conflict. So I guess I would point out that even events that are tragic and take their toll on human lives, like, for example, 9/11, tragic, horrific event. The market toll was extreme. Airlines were down 30% within the next week. These are cataclysmic events. But what's interesting is unless there's a real kind of material fundamental change driven by these events, we normally see that geopolitical shock fade and gains are more than enough to compensate over the next 3 months. To your point, maybe it's different. And I think what we're watching to make sure that it's not different is, when we see de-escalation, when we see any sort of potential resolution, what kind of toll this takes on Europe, what kind of impact this has on confidence both across European and U.S. consumers and corporates. And I think that, what this does, though, is it solidifies the notion that we are at peak globalization and we are in a different environment. That started a few years ago with the trade and national security risks with China. And what we're seeing is just, further events that just solidify the notion that we're at a point where global supply chain risk is paramount. We're seeing companies plan to onshore or nearshore their operations. So I think this is all, kind of playing through. This event in particular, we need to see whether it is resolved more quickly or whether it actually takes its toll on confidence on the economy, et cetera. I think what's important to remember about the U.S. is that we are energy independent. So the good news is we don't necessarily rely on imported oil, and that's an advantage in this environment. Europe is not, and I think that's a disadvantage in this environment. So I think those are the things we need to pay attention to when we think about relative asset allocation. I also think, Joe, this volatility can actually represent opportunity. So our target for the S&P 500 by year end is 4,600. We looked like bears coming into the year. We now look like bulls. And I think what this means is there are opportunities to add exposure to sectors that have been beaten down by these events, by these optical risks. For example, semiconductors, technology, software. There are a lot of high quality tech companies that might be, at levels that suggest, great entry points. I still like energy. I think energy still has upside. So I think there are lots of areas within the market that you can kind of sift through and do some security selection. But to your point, I think volatility is likely to remain elevated until we do see a real, kind of more let's call it satisfying resolution.